Question 41. Which of the following types of fixed income security has the lowest degree of interest rate risk? So interest rate risk is ties into the price risk of our bond and tells us how sensitive we are to interest rates changing. So if interest rates increase and we have high interest rate risk, that might mean that the price of our bond is going to fall really far, which would be the case if we're holding longer duration bonds. So basically, fixed rate bonds are going to have more interest rate risk, and then longer term bonds are going to have more interest rate risk as well. So we're looking for lowest degree here. A, fixed rate bonds. Fixed rate bonds will have interest rate risk. So right now, I would put them at the top of they may have the lowest degree based on the other answers. So we need to look at that. B, floating rate bond. Floating rate yields are going to do what it says, float. So when interest rates increase, the floating rate bond yield is also going to increase. So there's no price difference, which means we do have a low degree of interest rate risk. It's going to be lower than fixed rate bonds. So I think we can cross off A. C, inflation indexed bonds. Inflation indexed bonds the principal is going to increase with I don't know if it's CPI or some other index, but the principal is going to increase. So you're protected there, but they do still have a lot of interest rate risk. If you look at 2022, for an example, in the United States, TIPS, which is Treasury Inflation Protected Securities, in a year when inflation was really high, those types of bonds still got crushed because they have interest rate risk, and interest rates skyrocketed, which hurt the prices more than the inflation helped their prices. So we can go ahead and cross off C and stick with B. Floating rate bonds are going to be our lowest degree of interest rate risk. Question 42. Lance Gibbons holds two fixed income securities, a corporate bond and a zero coupon bond. Details concerning his investments are as follows. The zero coupon bond matures in 12 years and is trading at a market discount rate of 5%. The corporate bond offers an annual coupon rate of 3.8%, matures in 10 years, and is trading at a market discount rate of 4.2%. Which of the following statements is most likely correct regarding his investments? So both bonds are selling at the same price, corporate bond is trading at a lower price, or the zero coupon bond is trading at a discount of 44.32 per 100 of value. Okay, so we need to calculate the prices of these bonds in order to figure this out. So let me pull this up here. Let's do the corporate bond first. So we're going to be plugging these into the time value of money functions to figure out the present value. So our N here is going to be 10 for the maturity. Our interest rate is going to be 4.2, and we're annual, so it will be 4.2. We'll put that in for our I. Present value is going to be 0, and then coupon will be 3.8 or 3.8% times the $100 par value, which is 3.8 still. And then our par value is 100. So we compute that. We get a present value of 96.78 or 79 to round. So that's going to be the price of our corporate bond, and I wrote that down over here. And let's pull in the price of the zero. So I've got the price of the corporate bond that we calculated. I wrote that down. So then the price of the zero, we could plug that into the time value function to figure this out. But a quicker way is to just do that future value, which would be our par. And then since there's no coupons to account for, we can just discount that by the discount rate to the number of years. So that's going to be trading at 55.68 for price. So looking at these answers, A, bonds are selling at the same price. We can go ahead and cross that off because since they're clearly different, 55 versus 96.79. The corporate bond is trading at a lower price. 96 is not lower than 55, so we can cross that off as well. And then for C, to get the discount, we're going to do par minus the value. So we get a discount of 44.3163, which rounds to 44.32, and we can go with answer C. Question 43. Rachel Lake evaluates the potential for bond prices to change given the market discount rate. she derives the following conclusions. Conclusion 1, the convexity effect can be observed as the tendency for bond prices to increase when market discount rates decrease. And so looking at this conclusion right away, this is describing duration, not necessarily convexity. The convexity effect is the phenomenon where price of a bond changes asymmetrically with changes in the market discount rate. So, for example, the price of the bond might increase more when the market discount rate decreases than it would decrease if the market rate increases. So essentially, it's kind of measuring the asymmetry of the bond. So this doesn't sound like a very accurate conclusion. So let's see if that comes into play. Conclusion 2, for two bonds offering an identical coupon rate, the maturity effect results in the longer-term bond being more sensitive than a shorter-term bond when the change in market discount rates is identical. This is going to be a correct conclusion. And if you just think about it kind of more logically, so if I'm holding a 10-year bond versus a 2-year bond, if you have a decrease in the interest rates, I get to hold the higher interest rate bond for longer in the 10-year versus the 2-year. So that's kind of where that price sensitivity comes into play. Meaning that in the example I gave, it'll be a larger positive price increase for the 10-year than the 2-year. All right, so then Lake is most likely correct with respect to conclusion 1 only. We can rule that out since when we were going through, we said that was incorrect. B, conclusion 2 only. Yes. Or C, both the conclusions, rule that out as well. Go with answer B. Question 44. An investor purchases a 5-year 6% annual coupon payment bond at 89.4535 per 100 of par value and sells it in 4 years. Following the purchase of the bond and prior to receipt of the first coupon, interest rates go down to 8.5%. The realized yield on the bond investment is closest to. So we've got a 5-year bond, but we're selling it after 4 years. So we need to determine how much money we made, basically without holding it to par. So the first thing we're going to do is we're going to find the present value of the reinvested coupon. So we're getting 6% or $6 annually for 4 years. And then we're going to find the new bond price under that 8.5% yield. And then we'll add these together, and then we're going to solve using a formula. So let me pull a bunch of information in here. Bear with me 1 second. All right, so the top is the first thing I mentioned. So we're going to be taking the present value of the reinvested coupons. So we collected 4 times for the 4 years. We're discounting those back by the rate that by that discount rate, since it's prior to the receipt of the first coupon. So that gets us 27.2371. And then at maturity, we would have been receiving 106. So then we're going to discount that by the new rate to get the value of the bond. So our new value of the bond is going to be 97.6958. We will add those two numbers together to get this top number up here. And then from there, we're figuring out the rate that we received over that time period of 4 to get us to what we bought for the bond. So this is basically ends up being the value that we realized. And then this is what we paid. And then we need to figure out the interest rate. So when we do the algebra here and solve, we end up getting R equals 0.08710. Or answer C, 8.71%. Question 45. Green Associates owns a 3% semi-annual coupon paying 4-year bond issue with a par value of $10,000. It is currently priced at 9783.14. The annualized yield to maturity of the issue is closest to. So we're going to be doing time value money calculation here. And let me pull in the calculator, clear that out. So we're going to be doing N of 8 since we have a 4-year bond paying semi-annually. So we'll do 8. We're going to be solving for I, so we'll gloss over that. Our PV is what we paid, so what we're currently priced at. We're going to make that a negative number. 9783. So that'll be our PV, and then our payment, because again, since we're semi-annual, it's going to be 3% times the par of 10,000, or I did the dividing first, so it's going to be 0.015 times 10,000 gives us 150. All right, and then future value will be that $10,000, and we compute I, and then the tricky part here is we get the semi-annually compounded interest rate. So if we just went right ahead, went too quick, we would have went with A, but we need to multiply this by 2, gets us 3.5868, round that, we get answer B. Question 46. An 8% semi-annual coupon payment bond has an 8-year maturity and is priced at 9.5%. The modified duration of the issue is 5.3515. The full price of the issue is 106.35. Ignoring the effects of convexity, the revised full price of the issue, if yields increase by 125 basis points, is closest to. So we're going to be using our change in price formula and focusing on that modified duration number since we are ignoring convexity. So that formula is going to be pretty straightforward. We're going to be doing minus the modified duration and then multiplying that by the change in yield. And that's given in basis points. So 125 basis points is 1.25%. So that translates to 0.0125 with what we want to multiply by. So we're going to be doing minus mod dir, gets us minus 0.0669. Then we do 106.35 times 0.0669 to get our change in price. And then we do 106.35 minus that change in price to get our answer, since our answer is in the new price of the bond. So we'll go with B, 99.22. Question 47. Alpha and beta manufacturing entities are identical in all respects except for industry cyclicality. Alpha operates in a cyclical industry while beta operates in a non-cyclical industry. If both companies increase their leverage levels by 10%, the credit risk will be A, higher for beta, B, nearly identical, or C, higher for alpha. So the key here is industry cyclicality. So industry cyclicality is going to affect how levered or dependent they are on the economic cycle. So a cyclical industry is going to do better during boom times in economic cycles, and then they'll bust during bad times in economic cycles. Whereas a non-cyclical industry may see some change during the economic cycle, but their earnings are going to be a lot more steady. So the cyclical is going to look a lot more like this, and the non-cyclical will be a lot more steady through there. So basically, we want to know, how does this affect the credit risk? So essentially, more cyclicality means more risk for the issuer, because if they're issuing debt up here in the economic cycle and then we have a downturn, that's obviously going to be a hit on their credit. Versus here, we're seeing some decrease in the earnings potentially, but not nearly as bad. So that's going to lead to alpha, which operates in a cyclical industry, having more credit risk. Answer C. Question 48. ABC Incorporated has invested in a 5-year convertible bond issue trading at a price of $1,050. The issue is convertible into the issuer's common shares at an exercise price of $42. The exhibit gives the price of the issuer's stock over a 5-day term. So we've got day 1, 36, day 2, 32, day 3, 42. So that would be our, we're hitting our exercise price there. Day 4, 40, day 5, 34. Conversion parity will occur on day 1, 3, or 4. So conversion parity is essentially going to mean when the price of converting, or when the convertible bond, if we convert, would be worth the same as what it's trading at essentially. And we're going to hit that when we hit our exercise price, which is going to be $42. So that's going to happen on day 3. And go with answer B. Question 49. Bonds that are issued by the government and backed by tax revenues are least likely known as. So what bonds are not backed by tax revenues? That's what we're going to be looking for. A, sovereign bonds. So these are bonds issued by federal government, which can certainly use tax revenues to be paid back. So we'll rule that out. B, non-sovereign bonds. We can also rule this out. This is going to be like in the United States, non-sovereign bonds are still government related. It's just going to be backed by the tax revenues of a locality. So that might be your state or county or something like that. And they're all jurisdictions that have some type of tax power, so they can use revenues to pay those back. Then C, quasi-government bonds. So these are going to be issued by government agencies. An example I saw was something like toll roads, where it might be issued by the authority, some government agency authority, and then they use the proceeds from the toll road to kind of pay back those bonds. So there's still revenue in that case from the toll road, but it's not tax revenues. So we'll go with answer C. Question 50. Which of the following issues has the highest seniority ranking in the event of default? Subordinated, senior unsecured, or senior unsubordinated? So I'm just going to pull in a rough order here that's probably good to just kind of commit to memory. So the order in event of default, first is going to be the secured creditors. So that's going to be creditors who are backed by some type of collateral. So if the company used some type of collateral of assets on their balance sheet, that's what's going to kind of fall in there. In our answer, we don't have any secured in our rankings, so we can kind of move past that. Next, we're going to have unsecured creditors, and they're going to fall above the subordinated creditors, who are going to fall above equity holders. So looking at this, we have unsecured, and then we have subordinated and subordinated. We can see unsecured falls above that. So we can go ahead and rule out A and C and go with B. And then when you look at it, so we have subordinated versus senior unsubordinated. Senior unsubordinated is going to fall above regular subordinated.